I was thinking the other day about how Warren Buffett is mostly known for his multi-billion-dollar investments like Apple and Bank of America. But contrary to popular opinion, it wasn't always this way. And just like you and me, he had to start out by investing small sums of money too. At one of Berkshire's annual shareholder meetings, he was asked what advice he would give to those working with small amounts of money, just like he once had to do as well. And in this video, he gives us his response.
Good morning, Mr. Buffett and Mr. Munger. Mr. Buffett, I want to ask you this question last week when I ran into you after Gillette's annual meeting, but I choked. So now there's no pressure, here goes. In the years, from my reading, in the years from 1956 through 69, you achieved the best results of your career quantitatively, 29% annually against only 7% for the Dow. Your approach then was different than now. You looked for lots of undervalued stocks with less attention to competitive advantage or favorable economics and sold them rather quickly. As your capital base grew, you switched your approach to buying undervalued, excellent companies with favorable long-term economics. My question is, if you were investing a small sum today, which approach would you use?
Well, I would use the approach that I think I'm using now of trying to search out businesses where I think they're selling at the lowest price relative to the discounted cash they would produce in the future. But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. You mentioned that 56 to 69 was the best period. Actually, my best period was before that. It was from right after I met Ben Graham in early 1951. But from the end of 1950 through the next 10 years, actually returns averaged about 50% a year, and I think they were 37 points better than the Dow per year, something like that. But that I was working with a tiny amount of money, and so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap, and obviously as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it in that time. But I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically. But that's the nature of it. You've got when you get up to things you can put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals. And I did it twice. And I actually, looked at every business. I didn't look very hard at some. Well, that's not a practical way to invest tens or hundreds of millions of dollars. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. If you were, there's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money. Charlie?
Well, yeah, I think that's right. A brilliant man who can't get any money from other people and is working with a very small sum probably should work in very obscure stocks, searching out unusual mispriced opportunities.
Now let's discuss the key points that Warren Buffett and Charlie Munger talked about in this video. The first point here is that Warren Buffett says that if he were working with a small amount of money, he would use the same investing approach that he is using now. He then says his investment approach is to look for businesses that are selling for discounts to their future cash flows. Warren has also told investors that the number one question they should ask themselves is how much cash can a business return to you versus the price that you pay for it. He urges investors to focus on valuing the business behind the stock price, then seeing if the price of the stock makes it a worthwhile investment. For example, Microsoft has produced $63 billion in cash flow in the past year. Its market capitalization, or the price of the business, is also $2.8 trillion today. This means investors are paying $2.8 trillion for $63 billion in cash flow. Now, what Warren Buffett does is think about this in terms of a percentage, which is also known as the free cash flow yield. The free cash flow yield is basically the percent return the business can return to you from its profits versus its price today. Microsoft currently has a free cash flow yield of 2.3%, so this is how much the business behind the stock can return to its shareholders today. This is not a very high yield, which means Microsoft's stock is arguably selling for a very high price today. Historically, Buffett has purchased businesses in the 7 to 10% yield range, which gives him a higher return on the price he is paying. He then asks how confident he is that the business will continue to produce and grow its profits in the future. Because if the business's profits decline, then so will the amount of cash it can return to him. To put it simply, Buffett looks for businesses with acceptable yields, and that he is confident will continue to produce and grow their profits over the long term. This combination of a higher yield on cost plus profit growth is the heart of his investment strategy, and he says he would still be using it even if he were working with small sums of money. He then says the universe of possibilities is larger when you are working with small sums of money. This means that if you are working with smaller amounts of money, then you have much more investment opportunities. The reason for this is because when you are working with small amounts, you can place a higher percentage of your portfolio in smaller businesses that are growing rapidly. For example, Berkshire's cash position is now over $140 billion. This means that if Buffett found an amazing opportunity in a fast-growing business with a $1 billion market cap, then he wouldn't even be able to place 1% of Berkshire's cash into that stock. In fact, if he bought the entire business, it still wouldn't use up 1% of Berkshire's cash position. However, if I found this same business, then I could easily put my entire investment portfolio into this one stock and benefit massively from the business's growth. This would allow me to compound my portfolio at very high rates of return with this small business, instead of just a smaller portion of my portfolio. Since Buffett is now working with so much money, he basically can only invest in extremely large businesses, where he can invest billions of dollars. It is simply not worth his time to try and find and invest in smaller businesses anymore, and therefore, his investment opportunities are limited. He then says his returns were best when he was working with a tiny amount of money. And the reason for this is because the world of investment opportunities was so much larger. There were multiple periods in his life where he would place his entire portfolio into just 1 or 2 stocks that he knew would compound his money rapidly, which led to very high rates of return for him. However, again, he can no longer do this due to how much money he is working with. Therefore, us being smaller investors gives us a significant advantage over Buffett, because our universe of opportunities is so much larger. This is also why he says you can make very significant sums with small amounts of money. But there is a little bit more behind this reasoning too. It is easier to compound small sums of money versus large sums, and here's why. What sounds more achievable? A business growing its profits from $1 million to $10 million, or $100 billion to $1 trillion? In both of these examples, the businesses are growing their profits by 10x. But it is significantly easier for the smaller business to grow its profits to $10 million than it would be for the larger business to grow its profits to $1 trillion. To put this in perspective, $1 trillion is half the size of Canada's GDP. This means the business would need to generate profits equal to half of Canada's entire economy. So as businesses grow, it becomes more challenging for them to continue growing quickly, whereas small businesses have an easier time growing their profits rapidly. A great real-world example of this is Boyd Group Services, which has grown its cash flows from $4.6 million in 2003 to a peak of $388 million in 2023. This is almost 100 times growth of profits over the past 20 years. Now, if we take a look at Microsoft, it has grown its profits from $14 billion in 2023 to $63 billion today. This is growth of about 4 times over the past 20 years, which is still strong growth, but not nearly as strong as Boyd. Additionally, which business would have an easier time growing its profits by 10 times from today? Boyd or Microsoft? Boyd would only need to grow its profits by $3.5 billion, whereas Microsoft would need to grow its profits by $540 billion. Due to Boyd being a much smaller business and starting from such a smaller base, it was able to compound its profits at a much higher rate. Additionally, since it is still a smaller business, it should have an easier time compounding at faster rates in the future too. Now, if we take a look at Boyd's returns versus Microsoft's, we can see that since 2006, Boyd has massively outperformed. It has produced returns of 28,000% versus Microsoft's 1,100. And don't get me wrong, 1,100% is still incredible, but 28,000% is absolutely insane. This means $10,000 invested in Boyd back in 2006 would be 2.8 million today, or nearly 300 times your money. This is exactly what Buffett means when he says you can make very significant sums with small amounts of money. Charlie then provides us with the last important point, which is that if you are working with small sums, you should look in obscure stocks for mispriced opportunities. The definition of obscure is not discovered or known about. So Charlie is saying to look for undiscovered stocks that not many people know about. Think about investing in terms of supply and demand. Everyone knows about Microsoft, Apple, and Tesla. These are not businesses that no one has heard of, and basically everyone on the planet knows about them. These businesses are heavily followed by investors as well, and a large amount of people own these stocks. Therefore, there is a lot of demand for these stocks as well. Now, in the world of investing, I view price ratios as the demand for a stock. And here we can see that Tesla, Apple, and Microsoft are all trading for price ratios near or above 30, which are quite high. This suggests that there is a large demand for these stocks. Now, if we convert these price ratios into yields, we can see that Apple's is 3.3%, Microsoft's is 2.3%, and Tesla's is 0.5%. All of these yields are quite low, which again is due to these stocks having high investor demand. Now, if we go take a look at Boyd back in 2006 when it was just a tiny company, it had a price to free cash flow of only 1.6, which is equivalent to a free cash flow yield of 73%. This means that back in 2006, investors buying Boyd were getting a 73% return on the cost of the business, and were buying a business that would end up growing its profits by nearly 100 times over the next 20 years. There was an incredibly low demand for Boyd's shares back in 2006, which led to the business selling for a ridiculously cheap price. In fact, many people, including myself, probably didn't even know Boyd existed back then, as it was just a small Canadian auto repair business. People were not looking for a business like this, and it seems like it went largely under the radar. Unfortunately, Boyd is now a much larger business that people have discovered, which has led its price ratios to expand as demand for the stock has increased. But it still provides a perfect example of the kind of obscure business that Charlie was talking about, and the type of small business that can produce significant returns for its investors. So to summarize the key points of how Warren Buffett would invest small sums of money, he would use the same investment strategy of looking for high quality businesses selling for acceptable prices that he believes will continue to grow over the longer term. However, he would be looking at smaller businesses as they can compound money much more rapidly. Smaller businesses are more likely to be overlooked by the market as well, which leads to them selling for significantly lower prices and as a result, offer much higher opportunity. So for us smaller investors, it could be worth our time to look for smaller, obscure businesses instead of the stocks everyone is always talking about and are already well known by the market. On my channel, I do my best to try and find these types of businesses, as I would love to find the next Boyd. So if you are interested in the stock market and investing, then consider subscribing to my channel. Also, if you enjoyed this video, then please consider leaving a like on it, as that would really be awesome and it helps my channel get in front of a wider audience. But with that said, thank you so much for watching. I truly do appreciate it, and I really hope to see you all again in my next one.